Is commercial real estate the next shoe to drop that will ultimately crash housing prices? At the moment, there's a lot of headlines circulating the internet about commercial real estate, about how the upcoming crash in commercial real estate is actually going to be worse than the 2008 crisis. On top of that, you got some saying commercial real estate market faces next wave of financial stress, on top of commercial real estate starting to see the consequences of high borrowing rates. In addition, concerns grow as tighter lending threatens commercial real estate. So how much of this is actually true, and how much of it is clickbait to actually get you to click on the article? Well, in today's video, we're going to dive into commercial real estate in a little bit more detail. Now, I don't personally talk a lot about commercial real estate because I primarily sell residential real estate, but there's a belief at the moment that as commercial real estate crashes, if you will, it's ultimately going to bring down housing prices. So in today's video, I want to talk about that in a little bit more detail. I want to talk about what is actually happening in the commercial space. Why are these headlines actually coming out, and discuss whether any of it is actually true, in addition to talking about how it is likely to affect residential real estate in some way, but not likely the way that you think. Now, before we dive into that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on everything real estate related. So prior to the last couple of years, you didn't really hear anything about commercial real estate, right? Because people had a job, they went to the office every day, they did their job, they came home from the office. But COVID absolutely interrupted that because it gave people the opportunity to work from home, with many businesses out there changing their business model entirely, allowing workers to now do Zoom conferences, not come into the office at all, and in theory, changing the entire landscape of the working industry. And that's why people were able to move, say, out of California to areas like Arizona, areas like Texas, still keep their California job, but ultimately live in another location. And that's partly what drove house prices up so much, is because you had people with the ability to now migrate out of an area that they've lived their entire life, still keep that same paying job, but go live in a more affordable market. And because of the lack of inventory out there in the market, super low borrowing rates, it made that move make so much sense. And that's why you saw these huge migration patterns all over the country. But since COVID has become under control, actually you have about a third, 35% of workers with jobs that can be done remotely, working from home all the time, no longer going into the office, which if you go back a year ago in January, it was sitting at 43%. And in October of 2020, it was sitting at 55%. And back then, the conversation was, well, wait till all of these workers have to leave their homes and go back to the offices. They're going to have to sell their properties, and then they're going to have to move back to wherever their job is. And that didn't happen. What we saw is employers actually adapt to this new working environment, because only about 7% of people worked from home prior to the pandemic. In addition to that, you have about 30% of workers working from home at least 2 days a week. So what you have is a lot less people going into the office. So how does this affect commercial real estate? Well, commercial real estate is a different animal entirely, primarily based on the way that it's financed. For example, when you're buying residential real estate, you're often getting a 30-year fixed loan. You're getting a loan for a fixed term versus commercial real estate. Commercial real estate are typically short-term loans, usually only fixed for maybe 3 to 5 years at a time. And how those loans are financed is actually different as well, because financing commercial real estate is largely based on the occupancy of that building and the income that it's generating. So what happens is when somebody goes to finance a commercial office building, they look at the occupancy of that building. And so if we go back prior to 2020, occupancy in these buildings was really, really high. We'll say 80 to 90% occupied, which means the rent roll on that property was likely really high as well. At the same time, money was really cheap, and it got even cheaper during the pandemic. And many of these buildings were able to be refinanced at lower rates. But since then, everything has changed. People started working from home, which means a lot of companies are no longer renewing their leases. And in turn, not only is the occupancy down in those buildings, but the income associated with the lack of occupants is also down. And because most of these loans are short term, what happens is now the loans are starting to come due, where essentially that fixed period is over and the loan's going to start adjusting. So what happens is the owners of these commercial buildings go back into the bank, usually where they originally financed the loan, and they try to get that lender to refinance back at more reasonable terms. But because money is no longer as cheap as it was, with the Fed raising interest rates, in addition to tighter lending standards and money supply out there being more or less non-existent to some extent. In fact, we just got new M2 data, which is the money supply, showing that it's down 4.63% from last year. Now, this is the fastest pace of money supply destruction since January of 1933. And for those of you not familiar with M2, it's basically the various forms of money out there that's available for spending, on top of being an economic indicator that's used to assess the overall money supply and credit conditions. So when we have less M2 money supply out there, we actually have tighter credit conditions as well as decreased spending power. So what I'm saying out there is a lot of these banks that are going to have these commercial owners coming in trying to refinance the loans aren't going to be able to do it because of tighter credit conditions. On top of many banks out there that are already holding on to these types of assets, not being in a position to get them off their books without potentially selling these properties at a big discount. And that's exactly why Jamie Dimon warns that souring commercial real estate could end up threatening some banks. He says that you're already seeing credit tighten up because it's the easiest way for a bank to retain capital is not to make the next loan. So by the bank not financing that loan, they're retaining that capital, but they're also putting themselves in a bad position because now they have a piece of commercial real estate that could end up in default. And that's why he goes on to say that real estate is going to be a big problem for some banks, as lenders with the most exposure to commercial real estate are probably going to be hit the hardest. On top of that, you have Morgan Stanley forecasting something worse for commercial real estate, basically saying that it could be hit hard for years to come. So before we actually talk about how this is going to affect the residential market, let's talk about what sectors of commercial real estate are doing well and which sectors are likely to get hit the hardest. Buildings that deal with medical, industrial buildings, retail buildings, hotels, all of those pieces of commercial real estate are still doing really, really well. But it's those large office buildings, those skyscrapers full of offices are the ones that's doing the worst and likely to get hit the hardest. So the question that you guys have all been dying to know is, how is it actually going to affect residential real estate? Well, I don't think the fall of commercial real estate is going to necessarily affect the prices of residential real estate, but I do believe it could affect it in other ways. Over the last couple of years, you've had some big buyers in the residential space. You know, companies like BlackRock out there buying a ton of properties across the nation, ultimately turning those properties into rental properties. Well, what happens with a company like BlackRock if they start to see this fall in commercial real estate? Well, they own a lot of commercial real estate. In fact, they own a lot of office buildings out there. So what I think you're more likely to see is some of those bigger companies that own a bunch of office building being less inclined to want to spend their money on residential real estate because they're ultimately going to want to try to save capital and preserve as much of their assets as they can by doing their own tightening with regards to lending and buying other pieces of real estate. But on the flip side, if one of those companies like a BlackRock that owns a bunch of commercial real estate started offloading all of their residential real estate for some reason to try to create capital, if you will, well, if you're in a market that has a ton of that type of property, then that could end up being a concern. But quite frankly, I don't really see that happening. I don't see how the commercial real estate space is going to feed into the residential real estate space. It's really two different animals. If we go back and think about what drove house prices up during the pandemics and still driving prices up now, it's the lack of inventory and a huge amount of buyer demand. Well, changing the commercial space doesn't really change buyer demand, doesn't really change inventory unless you see a flood of inventory come to the market, which again, I don't think is likely. But those two same principles is what has created the quote unquote downfall that's coming in commercial real estate. What you have is an oversupply of office space and less demand out there for it. So as we always talk about, supply and demand drives market. So unless you see a way that commercial real estate is going to create more residential real estate, then it's not likely to have the effect that many people out there want to see.